Okay, so we are live now, and I'm not streaming this to any other platform. This is actually just streamed within the. So we have 4 people who have joined, and while we wait for about 2 or 3 more minutes for folks to join, I'm gonna just go ahead to present my screen. I have a short presentation here. I hope I can look at that. Um, right here. Thank you for joining us today, this wonderful start of the morning. We are going to wait for a few more folks to come in. I believe we just give extra 2 to 3 minutes more, and then we can get started. Um, this is going to be an exciting session today. I'm going to try as much as possible to stay within the allocated time so that we don't take too much of your weekend. But if you do have any questions, I would ask that you please leave your questions till the end of the session. And Eric, Dr. Bayo, myself, or you can also respond to those questions as well. But again, we're excited to have you here, and we're going to be starting very shortly. Let me share my screen. Let me see my screen. Share screen. We have 5 people so far. Thanks. Share screen. So just okay. Give me a few minutes to share my screen here. Trying to share my screen. Share screen. Can you all see my screen? I'm trying to share a presentation. Can you see my screen?
Not right now.
Not right now. Okay. Um, okay. I think it's asking me to edit that. Okay. Hmm. Window. How about now?
Yep, you can.
Okay. Perfect. Okay. Okay. So I think it's time to start right now. Okay. All right.
Okay.
Thank you for joining us. We're going to get started now. My name is Taiwo, and I'm excited to be here with you this morning. And we are going to be talking about the tax benefit of oil and gas investing. The reason why we are here is because we have, as a CPA, I've gotten a lot of questions around investment in oil and gas, and I just wanted to make sure that once my clients have access to this information, just in case they want to get invested in the industry. And then I also have folks that are my followers on various social media platforms that do ask questions like this as well, like how do I save on taxes? What are the strategies that we can implement to save on taxes? Are you seeing my presentation? Just so I'm sure that I'm. What?
Yeah, we
Okay.
have the first slide. The first
Okay.
slide of the pictures.
Okay. All right. Okay. And so that is why I've decided to, I'm very, fortunate and privileged to be connected with Dr. Fasanya and Eric. And so I reached out to them and asked that they should join me to, present this webinar today. I'm also very excited to we also have a third person in our midst right here. I'm sorry, this is my first time using, you know, StreamYard, but hopefully it's going to work out fine. So I'm also so excited to be joined here by Rex as well, who is also a member of the King's Corporation. And so for us to begin, I'd like to introduce myself. My name is Taiwo, and I am a CPA. I'm licensed in Texas and Indiana. I obtained my CPA license in 2015, and I also have a bachelor's and master's in economics. I've worked in the corporate America I worked there for about 5 years while in corporate America, and I worked for a Fortune 200 company. I was responsible for the five distribution centers with a combined revenue of 120 million. And while I was there, I was also, running my accounting firm, and I started that about 8 years ago. Now, 8 years ago is when I've been working with small businesses, and right now, this is what I do full time. My goal is to help my clients save money on taxes and also grow wealth as well through investment, through tax planning, through alternative investment opportunities. I'm married with three kids. And before I go on to the next stage, I would like to also specially thank Dr. Fasanya and Mr. Eric. Apologies to Rex because I didn't have I just got to know that you're going to join us yesterday, and I didn't have enough information to put you on slide here. But we are really very grateful for our speakers this morning. They are very busy individuals, and they have decided to spare some of their spare time with us, and we are so grateful for that, for them joining us and sharing their expertise with us. Before we go ahead, I would like to, put a disclaimer out there that whatever we are discussing today is just going to be for informational purposes and educational purposes. This is not to say that it is a tax advice, it is not a tax consultation or tax advice. And so do not take this as absolute strategy to go implement. You definitely need to be speaking with a tax accountant, your either your CPA or whoever does your tax, to kind of discuss this strategy with them. If you do not have anyone, or if your CPA is not vast enough in tax planning, definitely you can reach out to us. We may be able to help as well. But again, this is just for informational purposes. This and so why we are here, that's the question, the first question. And just before I go on again, I'm going to quickly just talk a little bit about how this is going to play out. So the goal of this webinar is again to kind of help you understand how you can invest in oil and gas, to understand the tax benefits, and then to kind of understand some of the operational aspects of it. And so that's why we have the speakers here. I will be presenting for just about a few minutes, about 5 to 7 minutes, just a few slides, and then I'll hand it over to Dr. Fasanya, who is going to introduce himself, and then also to Eric and then Rex as well. And the goal is that Dr. Fasanya has invested in oil and gas. Um, I would call him a serial investor, right? He has invested in real estate. Is a big he has invested very hugely in real estate as well, and now he's also investing in oil and gas. So he's going to share with us his experience as an oil and gas investor. He's also going to tell us a little bit about his transition and how he's moved from being. He's still a medical doctor. He still practices as a medical doctor, but he's going to walk us through some of his experiences moving through the various investment strategies and up onto oil and gas. And then the bigger part of the session will be shared with Eric and Rex, because they are going to be talking about the key things, what we need to know about, the investment, what is required, and the risk that is involved as well. And then we'll wrap it up with questions and answer. So, but the first thing I want to talk to you about is to kind of my own part is just to present for about 5 minutes, and so it's going to be very quick. But I want to talk to you to kind of bring us back to why we are here, right? So technically, every one of us as individuals are either W-2 employees, or we are business owners, or we are strictly investors. But when we think about everything that we do and how the income that we get is being taxed, we kind of get concerned. Perhaps are there strategies that we can do? What are the things that can be done to help us minimize our tax exposure? You may not actually think that you pay a lot in taxes. But I can tell you for sure, based on experience, based on what I've seen, and based on what I've read, and based on what I know, is that about every individual pays at least minimum of 30 to 40%. Actually, some folks pay as high as 50% of their income in taxes. So taxes becomes the biggest expense that anybody could have. They are the biggest. However, the problem there is that we don't usually see it that way because they are taxed at different periods of the year. Your property tax is paid at a different time of the year. Your sales tax is taxed at each time you purchase stuffs from the grocery store or whatever, and then your federal income taxes are taxed as you earn them. So because of this different timing of the taxes, we don't get to really sit down and say and assess how much we're paying in taxes. But quite frankly, I can tell you that that's the biggest expense that we have. And so, but what it becomes a problem for most people that are high earners. So what we've seen is that by the time you begin to earn close to $200,000 or more in a year, actually before you even get to that point, maybe you are a single household and just an individual. By the time your income is getting to 150 to $200,000, taxes becomes a nightmare because you are essentially seeing your money taken away by Uncle Sam. And so the problem there is that how do you the question then comes is how do we save on taxes? What can I do? Right, what can we do? And so this kind of just kind of awakens us and let us realize that you have to take action, right? You don't want to make your taxes, your hard-earned income be taken away by Uncle Sam. And so that brings me to this slide, which is the cash flow quadrant, right? I always want to talk about this quadrant because some of you may be familiar with this. This is a quadrant from is Robert Kiyosaki's cash flow quadrant. If you are not familiar with Rich Dad Poor Dad, I would advise and suggest that you go read that book. It's very very insightful, very valuable information. And so, but when you look at this quadrant, what I'm going to be talking about is just the tax part of it, right? But this quadrant, in some is just telling us that every individual falls into either of these four categories. It's either you're on the right side or you're on the left side. And for individuals that are on the left side, it's if you're an employee, what it means is that you are trading your time for money, right? You are working for someone, and your active work determines how much you earn. If you don't work, you don't get paid. If you don't work, you don't have income. Then the next part is the self-employed. Yes, self-employed are individuals that people like the sole proprietors, where without them working in the business cannot run. It's just a single owned run business wherein you're the only person running the business. If you decide to go on vacation today, that business is closed, right? That's a self-employed. And what that means is that you're still working very hard. It's a better position to be in than employee, but it's still not the best position to be in when it comes to growing wealth and when it comes to taxes as well. But the best positions to be in are the two on the right, which is the business owner and the investor. Now, the business owner are those that own businesses, and they are they are really running their business in a way that they are not working in the business, they are working on the business, which means they have employees doing stuff, they have people that are making things happen within their business. And if they decide to go ahead to take a vacation today, the business is still going to run smoothly. And so they are people that have employees working for them, and they are saving time and saving their money. And indirectly, you can say they are also passive income earners because they are not actively involved in that business. And then the last one are the investors. This is where we have the real estate investors, we have investors in investment in the oil and gas, investment in agriculture, investment in the stock market, right? So, but when you look at the tax structure, the US tax code is structured in a way that it incentivizes the people that help the economy grow. And who are those that help the economy grow? Those are the business owners, those are the investors. You may begin to ask, why is that? And that's because the government cannot do everything. And that takes me to the next slide. I'm going to still come back to this, but that takes me to the next slide. The US government cannot do everything, right? These are all of the things that, the economy is so big, and it's not actually only US government, just several governments in other developed countries as well. They depend on the private sector to handle some critical aspects in the economy that they feel like is better handled by the private sector, right? And so what the government does is that in order to encourage the private sector and individuals to go into some of these real investment opportunities, they have incentives. They incentivizes these individuals. There are tax breaks, there are incentives, there are credits and subsidies available for those that are ready to go and invest in those critical areas that the government wants private individuals to be a part of. And those are the entrepreneurs. So the entrepreneurs, when you look at it, government is not able to create jobs for everyone. And so they want people to start businesses, they want individuals to go into businesses. And so because of that, they have a lot of tax breaks, they have a lot of incentives for business owners. So business owners have those incentives. The same thing goes for real estate investors. Government understands that housing is a very critical aspect of the economy, and so they cannot by themselves take over that. And so they also incentivize real estate investors by because they help to provide affordable housing. You see all the apartment complexes you see out there, the multi-family buildings. Those are mostly owned by individuals that have come together, form a partnership in a syndication. Where they're now building these multi apartment complexes. So those are the things that government wants us to invest in. Also, is oil and gas. Oil and gas is another thing that government understand the importance of that. And so because of that, they also have actually I would say oil and gas is the sector that has one of the best tax incentives when it comes to investment. It is, I mean, the deductions is crazy. The things that you get when you invest in oil and gas is actually, I would say it's really mind blowing when we get to that point, right? And the same thing goes to farming. So how can government encourage people to go into these sectors? How can government tell people these things? The way they have decided to do that is by providing tax breaks and incentives for these individuals. And so when you're a W-2 employee, when you are in this part of the quadrant, you find out that you really don't have a lot of wiggle room, a lot of opportunities to save on taxes because the opportunities that you're not creating, you're not involved in those sectors that government wants people to invest in. You're not helping the government to also achieve their own fiscal policy, their own economic policy, because you are just, working for yourself, getting your paycheck and all that. And a lot of you that are here today may be thinking, how do I go? How the goal is for you to move from the left side to the right side. Now you don't have to move drastically. You can, either as an employee, you can be an investor in any of these other sectors. So you need to be thinking, how can I invest in any of these other sectors? Once you know that you have enough cash flow to be able to take advantage of these things, that is where you want to be, and that is when you begin to see some of the tax benefits in your taxes. Otherwise, you find out that you're paying a lot in taxes. Now, some of these are the investment options. I'm not going to talk a lot about this because my time is up. But essentially, the reason why I've highlighted the limited partnership, that is kind of what Eric and his team are going to be talking about today. Because when you talk about investment in oil and gas, you could invest in mutual funds, meaning that you could invest in mutual funds that are also investing in oil and gas, right? So that way, what you get, you don't really get to have all of the benefits from oil and gas investing, aside from the fact that you get dividends from your investments through the mutual funds, and then you also get taxed on that dividend. The capital gains also get taxed. Now, that doesn't give you the absolute benefit in oil and gas investing. If you want to tap into that industry as an individual, either a W-2 employee or even as a business owner, you need to kind of be involved in limited partnerships, and that is where this webinar is going to be talking about in a short while now. And then let me move really quickly to just a few things of what you benefit from, and then we're going to come back to this later on. But the very first thing I want to talk about is the tax benefit. So the first thing is that 100% of intangible drilling cost is a write-off, right? When you are invested in oil and gas, we have typically oil and gas operations involve their tangible drilling costs, their intangible drilling costs. The intangible drilling costs are things like the labor, fuel, and chemicals, things that are not tangible, right? That are not tangible, that they are not the assets and the equipment. These are normal expenses, intangible drilling costs. These costs are 100% deductible, and they actually account for about 60 to 80% of the exploration cost as a whole. Now, come to think of it, when you are able to invest, let's say you invested $100,000, and typically the IDC covers about 60 to 70% of the cost. So what that tells you is that you can eventually have a tax deduction of about $60,000 or $70,000 in a year, depending on how much you invest in the oil and gas, right? And then the same thing goes for the tangible drilling cost. Now, this one, yes, it's also this is the tangible drilling costs are the expenses on the actual drilling equipment, the oil rigs, and all that. Now, this particular one, you also get a 100% deduction, but the deduction is spread over 7 years. And then there's also the 15% statutory depletion allowance, which is for small oil and gas wells that are producing less than $50,000 barrels per day. These individuals also have a 15% statutory depletion allowance against their gross earnings. That's just a few of some of the things that you get to benefit when you invest. And there's also the potential for passive income, obviously. So when you're investing as a limited partner, you have access to passive income from this investment. And what that does is that a lot of time people kind of take it as a recovery of their investment. If you invested over $100,000, for instance, in on an oil and gas deal, you get to have passive income that will come back to you over time. So you can still recoup that investment back as well. And so this is just some of the things I want to talk about. But in the interest of time, I'm going to hand it over to Dr. Fasanya, who has experience, he has invested, and he's going to share with us some of his experience while investing. He's also going to tell us a little bit about his background as well. Um, Dr. Fasanya, you can take it from here.
Wow. Thank you, Taiwo. You basically covered most of the things already. So I do like the cash flow quadrant, like you said. And interestingly, I'm in every single quadrant, which is quite of interesting because I'm still working the hospital, employed position, even though I'm kind of transitioning to having my own private practice now that I'm financially free at this point. But also, I do have some self-employed business which cannot function on their own, right? Because it's in the early stages. And then I have business, right? We do a real estate syndication business, which we have about $143 million under management now in multifamily self-storages, offices, and luxury senior living. But at the same time, I also invest in stocks, crypto, venture capital, right? Oil and gas. So I'm kind of everywhere. So, but ultimately, though, like you said, my goal is to eventually move to the business, have systems in place so I can be in Nigeria having fun and my business continue to run. At the same time, I get my interest, dividends, and return on the passive on the investments, right? So that's the goal. Um, so you know, so as a physician, right? I'm a pulmonary critical care doctor. Work in the ICU and as a lung specialist. So during training, we train for a long period of time. So, oftentimes for me, I think I was about close to 32 years old when I finished all my training. Right? You go for years medical school, you do clinicals, then you do residency, you do fellowship. So by that time, we're starting late. So during those times, we get paid a little bit amount of money, right? In residency, I was making like maybe like $50,000, and at that time was even better than being a student, right? I was like, yeah, this is good. But I didn't really have a lot of tax issues at the time. So, so my goal at that time, I always imagine if I can make more money, all my problem would be solved. I feel like, man, I just need to start getting 200,000, $200,000, I'm going to be rich. Then you become an attending. Of course, you have still student loans and everything too, right? By that time, it's already $300,000 in loan. So, by the time I got my first paycheck, it was exciting, but then I saw almost half of it was taken off. Uh, so, it was good, but at the same time, I'm like disappointed a little bit. Like, almost like I'm being punished for being productive or being, being rich. So, so at first I was like, you know what? I'm going to just make more money, right? At that point, tax is not going to matter. So I pick extra shift. I do, extra things, and the more I make, then the more taxes again. So eventually, I figured it out that let's say you're making $300,000, to for you to work extra to make another 100,000, it's a lot more work than you actually finding a tax beneficial way to save $100,000. So then I started working on, because there are people that make $1 million, and then by the time everything's all said and done, you have 500,000 or $600,000 left, right? Which is good money, but you feel like what happened to the 400K? Whereas you could make, you could do half of the job, make 500K, and have all tax benefit and pay zero tax. I'm telling you it's possible because that's where I end up. So we started with real estate, right? So my wife is a real estate professional, which allows me to deduct, from my W-2. So we had so much depreciation that we have to carry it over for next year, right? From last year. Um, but because we have investors, and also, they're mostly W-2, they don't have the same ability to do real estate professional like I do. They're usually double physician family or just a single person that is working as a doctor. You're working too much hours as a doctor, so you will not qualify for that tax benefit immediately, right? For active participation. So then we look into oil and gas. Okay. So I have my mentor and my partner who was already investing with oil and gas for many years, and he was already with King Operating Corporation. So he gave me good reviews about them, and I look at multiple other companies at the same time. And about 2 years ago, I finally got interested in it. We talked to the group, and I took the leap. So it also turns out to be the perfect timing, right? Because that was when the oil price was going up. And by the end of the year, I saw my K1, right? I put $100,000, and then it was 90,000, you know, of depreciation to use. So they have promised like 75% or something like that. So imagine my surprise and excitement when I saw 90%. So, and then, so that one thing that first of all gave me the courage, to then introduce it to my investors, right? For Dr. BDZ Capital. And, there was one fund towards the end of the year. And the good thing is that even if you invest even the day before the end of the year, you still get that tax benefit. So many people are able to do that in December, and we got a lot of people in, and they were able to get the same benefit. So, so for me, it has become like my strategy now to use it, consistently, every year to add to it, for my W-2 income. Another thing is we actually did get a good return last year. I think we were at like 19% return. Correct me, Eric, but that's what I felt I have in my bank account. It looks good. So, I mean, this year was a little bit lower because of the oil and gas, which is Eric is going to talk about based on the risk, and the fact that the return fluctuates with the price of oil. But regardless, though, even if I get zero this year, that would be average of 10%, or 9.5% percent return, right, in 2 years, and at the same time get a 90% deduction. So it's a powerful tax strategy, and I always make sure I let all my investors know that there's an ability for them to do this same thing too. So that's just my experience.
Thank you, Dr. Fasanya, for that very wonderful experience that you took us through. And it's very interesting because a lot of people feel like you have to have this huge amount of money to invest in oil and gas. aside from investing in the mutual funds, not a lot of people understand that you can also be invested in the actual upstream operations through these partnership deals. And so, but this is a very insightful session, and thank you for sharing your experience. And at least knowing that you have gone through that process is a little bit comforting to people that okay, this is going to be this is something I can explore. If someone like you can explore it, I can also explore it. And you're already reaping the benefit, and then I'm happy about what you've been able to get out of that as well. I'm going to hand it over to Eric to kind of introduce himself, and then Rex as well, and then I'm hoping that you have a presentation for us. I have some questions that have been some folks have asked me before now, and so we're also going to go through that after your presentation. So over to you, Eric.
Well, thank you very much. Yeah, thank you to both of you. Great explanations here. I'm going to go ahead and try to share my screen. I've never been on StreamYard before, so give me just a second to figure it out.
We're all learning.
We are, yeah, it's trial by fire. Okay, I think I have it. Can you all see it?
Not yet.
Not quite.
Not yet.
Okay.
There we go. Can you see it now?
Yep.
Yes.
Okay. Can you see full screen?
Yes.
Yes, we can.
Great. Yeah, so my name is Eric Rice. I'm the Chief Growth Officer here at King Operating. I came here about 17 months ago for the sole purpose of seeing what's happening in the country right now. You know, we live in a world right now where our government is overtaxing us, and you all were very kind. I will say that the taxation process in this country is completely unfair, especially to W-2 employees. And it is definitely a driving force behind what I do every day, is understanding that, you know, the more capital we bring into oil and gas, the more sovereign nation we create by having energy independence. But at the same time, the wealthier citizens that we create, because they're not paying taxes to frivolous spending in Washington, D.C. So here at King Operating, we are an American company. We focus in on American oil from American soil. That's really what we're geared to do. You know, if you're interested in learning more about this, you can certainly reach out to anyone on the screen here, and we'll go ahead and get you a copy of this deck. But this is our disclosure slide. I try not to go through it in accordance with managing our time a little more properly. But I will be going through our strategy, the value in the investment, and why depth of knowledge is important moving forward. So currently we are raising $200 million. We're at $112 million raised right now since November of last year. So we're trying to close out $200 million. We are an income producing asset secured limited partnership. And we are looking to exit at our estimate, our management case at 1.34 billion in the next 3 to 5 years. So we are much shorter in duration than your average oil and gas deal, which I'll walk you through in just a moment. Our strategy is very important to understand. So from both sides of the table, on the left-hand side, what you'll see there is that an investment in this type of security absolutely provides significant tax benefits. You know, up to 100% of your contribution or your investment into the fund can be used to reduce adjusted gross income, like Dr. Bio talked about. You'll also receive monthly passive income. This has tax advantages, which Rex will go through in the end as well. But monthly distributions are very important. And the third and final benefit, aside from being patriotic and supporting American oil, which, by the way, we need drastically in this country, is an ROI. So in your normal oil and gas deal that people have been doing for the better part of 50 years, they're usually a small portfolio. They get a small piece of land, like 1,100, 1,200 acres. They want to raise your money to drill 1 to 3 wells to prove that the land will yield hydrocarbons. And then essentially you get a tax benefit and you get some income for 25, sometimes 30 years. But at the same time, the oil and gas company owns the leases. And as they prove that the land will yield, they actually sell those leases and you don't profit. At King Operating, we include our investors as full partners. So with King Operating, you'll get a tax benefit, monthly income, and you'll also participate on the sale of the leases when we are ready to sell in the marketplace. Because our entire strategy is to acquire property, develop it, and divest. We are, to think of us on a real estate side of things, we're very similar to a multifamily. Our goal is to build a building, provide tax benefits through construction, and upgrading, provide income every month, not rent, but instead of tenants and toilets, you deal with oil and gas. And then to be able to take the property that we've invested in and to sell it mutually as a team, and both profit from the value that we've created. So our business model is pretty simple, right? I'm just going to explain to you our process. The first part of this, our strategy. I want you to understand how we think, what we're targeting to do, and how it all works for your benefit, because it's for our benefit. We're all on the same side. So the first thing we do is significant geological research. Once the science comes back to us and says that this piece of land could be really good for us, we then acquire leases. Once we acquire leases, then we begin to raise equity, which is why we're on this call today. After that, we begin drilling. And what we're drilling for is what's called PDP, or proven, developed, and producing wells. Simply put, these are wells that produce revenue. The more revenue that we produce from a piece of land, the higher the value of that land is in the open market. While we're producing revenue through PDP production, we're also creating PUDs, or proven undeveloped wells. What this does essentially is it prepares the surface for future drilling, whether for us to expand revenue capabilities or for us to be able to sell to a future buyer who now has basically a foundation poured for a new building for them to build. What we do is very similar to real estate. We look at a piece of raw land. In real estate, we would build up, we would build a building. In oil and gas, we build down, we drill into the surface, and we create wells. Both of those two entities are designed to produce income. Now, on our pieces of land, they're very large. So what we do is, if you thought of it as a real estate, a PUD is very similar to pouring a foundation for a building that hasn't been built. So a future developer or us could look at it and say, well, let's build a building there or drill a well there. Most of the heavy lifting on the surface is already done. So those PUDs add tremendous value to us. So as we're going through this, in this case, we are raising $200 million. Once our fund gets to $400 million, or double what we've raised, then what we'll do is we'll open up the divestiture window, going out and looking for active investors to be able to either recoup capital for our investors or to create profit on an exit. Now, acquisition is very important. I know many people are new to oil and gas. They don't understand it. Our model is going to be different than anything else that you'll find in the market. Number one, we include the actual asset value for investors. That's a big difference. But at the same time, we also work in multiple basins. So we are always looking to work in 3 to 5 different BOFs, or basins of focus, 3 to 5 different areas, geological areas. This helps us mitigate the downside and maximize the upside. We're always looking for underdeveloped probable acreage with proven analogous production. What that means is we're looking for areas that somewhere close to us there are really high performing wells. That gives us a lot of information about the subterranean culture. We're always looking for a minimum 20 drilling locations on privately owned land or state-owned acreage. We try to stay as far away from federal regulation as possible, especially in these crazy days. We look for areas that are oil and gas friendly from a regulatory environment. We're looking to make sure that we're not going into a difficult situation. We have done that in the past, and I'll walk you through that. But we are always looking for attractive pay zone geology. I'm going to use terms you may not have heard. MPI, monthly passive income, PDP, proven, developed, producing, revenue generating wells, PUDs, and another one is going to be pay zone. So if you think of a stack of pancakes on a plate and you flip it upside down, each one of those pancakes would represent a different layer, a different zone underneath the surface. When they have hydrocarbons in them, we can get paid on that, so we call them pay zones. So we look for very attractive pay zone geology in all of our deals. And we're always looking for high control lease terms. So we do a lot of held by production leases. So we'll put some money down, generally a few $1 million on a piece of land, but we don't have to put too much towards that because we become partners with the landowner. So as long as we're drilling oil, we're producing, held by production. As long as we have production, those leases are ours in perpetuity. So these are very high control lease terms that allow us to have better divestitures in the back end. If possible, we look for PDP production or revenue generating land. It's difficult to find and very expensive today, so we are drilling from scratch on most of our properties. And we're looking for a 50-50, generally a 50-50 target mix between oil and gas because these markets fluctuate which one's more profitable pretty often. We like to have the flexibility of, right now we're focused on drilling oil because the cost or the price of gas is very low. But eventually that will turn around and we want to be able to have access to drilling gas when it's profitable as well. And of course, we're looking for geography as a footprint. So we want to have locations that are very close to the operations we have right now in order to save time, money, transportation, and team. So where we are right now, our original plan was to have 3 wells drilled by the end of July. By the end of August, we already have 5 wells drilled, so we're a little ahead of schedule there. We did make our 3rd acquisition, which we actually acquired our most recent fund. I'll walk you through that in just a moment as well. And our first MPI, or monthly passive income distribution, went out in August. So we're right on schedule for this slide here. It has been readjusted a few times because oil and gas is extremely difficult business, and at times things do fall behind schedule. But we are back on track right now, which is a great thing. Now, as I explained, we go through this process of, raising capital, leases, capital, PDP, revenue, PUDs, and then divestiture. So once we're at that $400 million mark, we'll begin to open up in the open market for sale part of our fund, primarily to institutions. Now, that won't happen for about 2 years from today. But 2 years from today, with looking at what's happening in the bond markets and most of the equity markets around the world, your average corporate bond rating is BBB, which is 1 step above junk. By next month, if not November or December, I'm assuming the ratings on those bonds will drop into junk on average, making 2 years from now a very attractive area for fund managers looking for income for their portfolios. So what we do at that $400 million mark is start opening it up. Our purpose is to be able to bring in another $200 million to recoup capital for our investors while maintaining ownership and future income. But that is a big play for us to be able to do that in 2.5 years. Once that is complete, we'll continue to grow the entire operation and keep building out and developing these economies of scale, at which time we will sell in entirety, transfer ownership even, to another purchaser, which will primarily come from a mid-sized to public company oil and gas operation, a larger independent operator, someone who's looking to expand their area with a proven field that they don't have to develop from scratch. That's what we do. Now, our existing operation right now, we have 6 other properties besides these 4 we're showing you, and we're actually in the process of completing due diligence packages and selling those in the open market, which, by the way, benefits you tremendously as one of our investment partners, because until your capital is returned, 100% of our divestitures go back in your hands. So we are looking to generate some additional cash flow in Q1 of next year by selling off 6 properties, which we've done a good job on, but they just don't necessarily fit in the portfolio today. So we want to sell them to other folks that can finish the projects. But right now we're up in Wyoming. We call it the Rhino Project in the Bighorn Basin. We have 52 contiguous acres. That number contiguous is very important. Larger oil and gas operators, people who will buy these portfolios from us, are not looking for small pieces of land. They're looking for large pieces of land that are all connected. In the oil and gas space, you'll find that some people own an acre here, an acre there, an acre there, and it looks like a checkerboard. Those are not attractive divestitures, or not attractive acquisitions for large companies. Contiguous acreage in highly profitable basins are really attractive to them. Places like Exxon and Shell, they don't do anything for under $2 or $3 billion or $1 billion. They're not looking for $25 million acquisitions. That's more along the lines of companies our size. So up in the Bighorn Basin, we have a great oil and gas mix. It's about 50-50. We have multiple pay zones right now. We've identified 4 different pay zones. We're working on identifying a 5th in the formations. We expect to exit from this property in the next 3 to 5 years at anywhere between 100 and 300 million. And our biggest risk up there is seasonal drilling. Wyoming gets very hot and very cold. There's a lot of snow there, and when the snow melts, there's a lot of mud. So we're able to drill about 8 months out of the year. We're just now approaching the time of the season where drilling operations would be futile. We would have to essentially drill a well and plug it until June or May or June of next year. So we'll be holding off on Wyoming for a little bit. That's messing with our schedule a little bit, just simply due to the fact that we're a little behind on drilling in Wyoming because we're so focused on Texas right now. Now, we also have some acreage up in Colorado, which I'll walk you through. This began as an oil and gas project. However, when we got this property, the political environment flipped from conservative to very liberal, extremely environmental, and we've had a lot of difficulties with that land. Now, it is fertile, does have great oil and gas, but the interesting thing is that the surrounding 3 municipalities or counties have gone through a tremendous drought over 2 years. So we've actually structured a deal where we can begin drilling for oil and gas, but if we can filter and sell to these municipalities our water, because when you drill oil and gas, you get a tremendous amount of water from underneath the surface. So we're in the process of converting this from basically a piece of property we probably would have let go years ago into a $20 to $60 million revenue generating operation selling water to municipalities. So drilling, engineering, things that we do on a daily basis have multiple prongs and multiple benefits outside of just oil and gas, because water is vastly and quickly becoming maybe the most valuable commodity on Earth, because most of the surface water here on Earth is tainted from pollution. So we have a risk up there of a sensitive community. So we will be allowed to drill for oil and gas. Part of our contract is that we have to sell them our water after it's been purified. So great opportunity for us. I love turnaround stories, and that is a piece of property that honestly was a flop for us, that is turning into a $20 to $60 million revenue generator for our investors. So we're happy about the way we've stewarded that. In the Cotton Valley project, very small contiguous acreage. There are 2,000 contiguous acres in East Texas, 100% natural gas focused, one pay zone. This is not a big divestiture. Certainly somebody will buy this from us, but not for a huge number. But we've identified one strong pay zone, and we've drilled 2 wells there. Unfortunately, last year, gas dropped from $9 to $2 literally in a matter of weeks, and it hasn't been profitable. So as we approach $3 in natural gas, we start to see profitability again. So we are getting ready to frack these 2 wells and complete them by the end of October. And we expect that to be anywhere between $7 and $15 million in free cash flow, along with a divestiture, because once we frack them and get them producing, we certainly will find buyers in the marketplace. But for us, we look at Colorado and Texas as ways of generating income, and Wyoming and Texas as big divestitures, which leads me to the Believers Project in Borden County, Texas. This is in the Permian Basin. If you are not familiar with oil and gas, the Permian Basin is a vast and large and robust oil field that competes with any oil field in the Middle East. There is enough oil and gas underneath the surface just in the Permian Basin in Texas to power every building, vehicle, plane, and train on planet Earth for the next 300 years. You'll continually hear in the news that, oh, it's running dry. It's not running dry. The oil is just deeper than it used to be. Now, this is a very interesting property. It's a bit of a unicorn. So we have a little over 21,000 contiguous acres in the Permian Basin with one landowner and one mineral right owner. That does not happen. Usually you see dozens, if not hundreds, of mineral right owners, because there's a lot of mineral right deals out there. And generally see multiple landowners, but we're dealing with one owner on each side of that. Heavy, heavy, heavy land and oil. We've identified 6 pay zones in the formation. This is really attractive. We're targeting a $400 million to a $1 billion exit just from that property alone. And our risk there is we have 6 pay zones. So 4 of them are very well known. We know how to drill them. A couple of the pay zones are tricky, one of them being the Mississippi and Chert. And we've already drilled a well in that of about 17,000 feet down and across a horizontal well. And in that area, we have gone through some bumps and bruises with difficult drilling, but I think we've ironed out all the kinks. And we're getting ready to get into that repeatable phase of well development, which is where all the money is made, is repeatability. And these are just maps. So there's a lot of people out there that'll show you stuff and never show you the maps. These are our maps. Everything we do here is 100% trackable through the Railroad Commission, all registered and cleared through permitting. It's a little bit about our plan. Some of these slides coming up, I'm not going to go through the whole slide just for time purposes. If you're interested, we can certainly get it to you. But it's important to note our Q3, Q4 focus. When we look at the Believers Project, we are in the middle. We're almost done with our 3rd well right now, so we have them drilled. We're right on schedule there. We plan on drilling another 3 before the end of the year because the weather is really good in the eastern shelf of the Permian as opposed to Wyoming. And we are putting together all of our packages for asset valuation, and we are just now ramping up revenue. So revenue from the Borden County project just started this month, and we have 5 wells that'll go online. So plenty of future production already baked in for you as an investor right now. December and January, we will see a pretty big uplift in MPI just based on this production. So it's really good there. The Wyoming project, we're in that planning phase right now. We're going to plan for spring drilling. We are not going to drill the 2 planned wells from Q3 up in Wyoming. Simply a matter of focus. We wanted to drill 2 additional in Borden County as opposed to 2 in Wyoming for weather purposes. The Cotton Valley, like I said, we're getting ready to frack and complete those in October. So for Q4, we'll be way ahead of schedule on that. And the water project in Colorado, we are looking to drill and complete the targeted wells by the end of the year up there. If possible, there's a lot of bureaucratic red tape to go through, but we're pretty much on schedule with the water project as well. So the value of these types of opportunities is what you're here to learn about. So as an investor, that's what you saw as the business side. That's how we focus our operations. But as an investor, as I mentioned, you get 100% write-off for the investment into these types of funds, these partnerships. I'll break that down in the next slide. On top of that, this year we're targeting, when we put targeted average or low average, these are monthly, annual run rates paid monthly. So we are targeting getting to that 8, 9, possibly 10% annualized return paid monthly. That'd be a $1,300 check on a $200,000 investment for the end of the year. That's targeted through the end of 2023. I will let you know that our overall numbers that we target for the next 4 years in this fund are 14 to 21%. And I think with the way the pricing is going in the market, supply and demand, and just the overall realization that we definitely need green energy, but we don't need to get rid of traditional energy. I think people are starting to realize that now. When you drop one and go to the other, it causes real big problems in systems. So we are targeting a 14 to 21% over the life cycle of this fund. And if we get to these numbers here, and even in the 8 to 12% range for monthly income, the value will be there. So we're targeting a total multiple on exit at 3.5. In other words, a $200,000 investment ends up being a $702,000 recoup. That is our high end. So of course, this is oil and gas. It's a tough business. It's a tricky business. And we have pricing fluctuation along with cost fluctuation. So we are targeting anywhere between 2.5 and 3.5x on the fund. Now, the tax piece, which Rex will get into in more detail, I try to keep it very simple. For the last 15 years, we've produced a 75% year one deduction. That means if you invest $200,000 in the fund, you get to take basically $150,000 off of your existing AGI. And at a 40% tax rate, that's a $60,000 cash on cash realized return just by making the investment. So significant tax savings. The rest of it's broken down over a 5-year period, but I'll let Rex walk through that for the CPAs on the call today. So as we are, in the middle of drilling, it's important to understand how the cash flow works. So when we pull hydrocarbons out of the ground and sell them in the open market, the first people who get paid are the royalty owners, the landowners. They get paid first, their percentage, and then the operating team that actually pulled the hydrocarbons out of the ground, they get compensated, and that leaves us with net profit. Now, until your initial investment is returned, we pay out 80% of net profits every month, month after month, to our investors. Once your initial capital is returned, then we switch to a 60-40 model because we're back-end incentivized. And that will go all the way through divestiture. And I get the question all the time, well, why don't you do 80-20 all the way through? Well, we make a bulk of our money on the divestiture. And as far as we know, we're the only oil and gas company that allows you to participate in that type of exit. Some companies do offer 10%. We offer 60% to our investors. And we think that that is exceptional because it doesn't exist anywhere. Since we have such a strong tie to real estate model, being that we're very similar to a multifamily structure, it's important to note comps. So deals like the one you're seeing with Northern Oil, who bought part of the Mascot project, they paid $330 million in cash to buy 37% working interest in the project. These types of deals happen month over month, 20 to 30 times every single month, like clockwork. That's who we'd go to for, say, a small divestiture to return capital to our investors and keep building. Now, after we've built and we've raised the value to a highly profitable environment, we'll have multiple buyers. Again, there'll be other oil and gas companies. There'll be, in certain areas, private equity. Private equity is getting hot and heavy in oil and gas, especially groups like BlackRock, who absolutely spend the most money telling people to have green energy usage only in their lives. Well, when they're doing that on TV behind closed doors, they're buying oil fields left and right. And these types of groups pay great premiums. We had a big private equity boom about 12 years ago in the business, and it's looking like we'll have another one in 2024 and 2025. So there are plenty of buyers for these types of operations out there. Now, we did do a sensitivity analysis. I'm not going to go through the whole thing here on the call. This is something that if you reach out to anyone on the screen here today, we'll get you the information. But if we look at our management case, this is our top of the line case. This is what we're working towards every day. At $85 a barrel, which is under where we are right now, we're at 91, and $5 an MCF for gas, which we're about a little halfway to home. Now, gas fluctuates. Gas can go from $2.50 to $7 in 15 minutes. It really is a volatile market. Oil is a little more steady because it's more global in impact. But we're looking at $85 a barrel for oil, $5 an MCF for gas. Our management case here with the properties we have is to get to about 12,000 barrels per day. At those prices, we will see a 3.5x exit at the end of a 3 to 5 year period. Now, we have put in here a sensitivity analysis ranging from $60 in oil and $3 in gas to $100 in oil and $6 in gas. In 2024, I think these numbers are going to be very low. What we're watching already is a massive ramp up. Our government has announced that they are willing to completely drain the Strategic Petroleum Reserve down to zero in order to manage costs of fuel. This is highly dangerous for national security, treasonous in some manners. If we went to war, we wouldn't have the oil we need to fight a war. But this is something our White House has said that they're willing to do in order to keep prices down on gasoline, which will be very damaging to the entire economy. On the flip side, if the SPR isn't used in the future, we will see real supply and demand pricing, which right now would be at about $121 per barrel. So there's a definite part of the market I'm happy to go through. I am a macroeconomist by nature. I look at everything, but we do have the sensitivity analysis for you where you can see if we had lower production and lower and moderate pricing, you can see where our multiples will come in. These are projections. These are not set in stone. The market conditions at the time will dictate. But we have gone as low as saying, hey, if we only produced the equivalent of 6,782 barrels per day at $70 oil, which I don't think we'll see for years, or $4 gas, which I think will be pretty standard, then we'd have a 1.6 multiple, and even lower at $60 and $3 for natural gas. So the sensitivity analysis, just like in real estate investment, is available for you anytime. Our depth of knowledge is important. So our entire team here, we have Jay Young. He's our CEO, fourth generation oil man, visionary. He's been around the block for a long time. Here at King, we've been open for 26 years. Ali Ahmed is come in as our chief operating officer. He's actually in a bit of an advisory position with some health issues at the moment, but a great addition to us. Graham Patterson came in as our CFO. He comes from the investment banking world in oil and gas, so he's helping us get our books ready for divestitures moving forward and cleaning up some of our systems. Nathan Myers is our chief legal officer. It's a very rare thing to have in oil and gas. Primarily, the legal teams are outsourced. Nathan saw what we were doing here at King and actually closed down his private practice to work with us. And he is one of the 300 board certified oil and gas attorneys in the entire state of Texas. Then you have that guy next to him, which is me. I deal with our investors' growth and some of our market conditions and raising capital. We have Tiffany Malden came in as our chief marketing officer. And then we have Rex, who is our EVP of analytics and taxation. Rex was our CFO for 15 years, and I think 15 years previous to that as a CFO at another oil and gas company. And he started his career inside the IRS working on oil and gas taxation. There is not a single person on planet Earth that I know that knows more about taxation and oil and gas than Rex. And he is here to help out all of you. If you have questions, you can work with your accountant at the end of the year or just provide some advice along the way. Michael Tanner is our director of finance and analytics. He's in charge of making sure that wells are economical and that projections are done correctly. Paul Jerome is the head of our geology department. He is really the point man on new properties, new wells, and locations. Kelly Duncan has worked with Paul Jerome for years in other companies, and they have drilled 1,800 wells successfully between the west coast of America and the Middle East. So they have drilled wells all over the world. Kelly's great. We brought him in a few months ago. His first 2 wells were under budget and ahead of schedule, which is always fantastic. John Malden came in as our chief economist. You may know John. He's been a very well-known author and economist around the world for the better part of 30 years. And he works full-time with us to help us navigate the markets. Garrett Stacy is our SVP of engineering. Garrett is in charge of, once Michael determines that things are economical based on the geological research from Paul and the engineering specs from Kelly, Garrett is the one that puts it in the plan and works on completions and productions. So very experienced team here. On this slide, you're looking at about 150, maybe 160 years of oil and gas experience and a few hundred years of business experience. So a little bit about our track record, which I think is important to walk through because it can be kind of confusing. Now, until 2015, we did oil and gas deals like everyone else. We owned the leases. We would raise money, give you a tax benefit, pay you on the income, and make a bulk of our money selling that lease to someone else without your participation. So when we actually flipped the the model around here, and we decided to include our investors in the land ownership or the lease ownership. We did a small test run. We raised $4.5 million in equity. We sold it for $13.5 million in 19 months. So the model has proven to be successful. Then we got into 2018 up in Larimer County in Colorado. Again, this went from a conservative, oil and gas friendly county into a radical, extreme environmental, progressive political environment in 2018. We had a lot of difficulties getting approval for permits and things like that. And to be frank with you, we were getting ready to let go of the property and just call it a day. But what we did is we grandfathered the asset and the investors into a new fund, because in 2020, there was a little thing out there you may have noticed that people call a pandemic. What it really was a black swan economic event. So I hate when people call it a pandemic, because to be honest with you, it was truly a black swan economic event. All economies around the world shut down for a month, and for months at a time in some countries, years at a time in others. We are still recovering from that. It's probably going to take 10 years for the world to recover from that one event. But it was a very difficult time for us. Oil went to zero. It was difficult to get workers. So what we did was we utilized the pandemic. We transferred, our program in Larimer County into a new fund. We started raising new money, and we started acquiring new properties that were abandoned during the pandemic. So while others were trying to figure out what to do, we were looking for great properties at great prices, which in our third program, our last fund, for investors who were in from January to December, they experienced a 19% ROI in a very difficult year in 2022. Now, in August, we raised a bulk of our money in 2022. What that did was it created new mouths to feed for the fund itself, but it didn't matter at the moment because we had $121 a barrel oil. We had almost $9 for an MCF of gas, and drilling costs were only up about 5%. Now, over the coming months, we saw a 35% increase in drilling costs, along with a plummet from $121 a barrel in oil down to about 65. And we saw natural gas drop from $9 to $2 in the matter of 1 month. And they stayed that way for a very long time. So we had a highly profitable fund that the cost of doing business went up 35%. And at the same time, the value of our product, the ability for us to profit, plummeted around 70 to 75%. Put us in a very difficult economic position. Fortunately, we already had our new program going with Borden County. We were looking for a third property. And what we did was we actually acquired our last fund into this one. So it's all combined now. And the great thing there is that we didn't have to put out, anywhere between 10 and 20 million for a new piece of land. We already had it. We got it for no cash. And at the same time, we acquired a bunch of properties that we know better than anyone on planet Earth. So for us, it was a logical, simple decision in order to keep Program 3 profitable, was to be able to, instead of dropping another 20 million on a piece of land and then 35 million on development, we were able to put some cash flow into new development and new production right away, which is now beginning to pay off as we speak in September and October. And that leads us into the program we're in now that we've gone through on this entire deck. So I do have a breakdown here. This is from our broker-dealer application. So this is a full breakdown of our monthly distributions and divestitures in our first and third program, all the way through essentially November of 2022. These Program 3 and Program 4 are now just simply Program 4. And that is what I have for you here today. Happy to answer questions and open that up here, but it's a very simple process. If you're interested, just reach out to anyone on the screen today. We'll put you in touch with the right person, get you as much education as possible about our deal. If it's something that makes sense for you and something that fits in, I always tell people, if you hate paying taxes, love passive income and a multiple on your capital, it's worth exploring. So if it becomes something that is worth it for you, you just have to determine how much you want to invest. We'll send you a subscription agreement. You send us a wire and you're in the fund, and you'll have your K1s by March of next year. So that is, I think, everything here today, guys, that I have for you.
Thank you, Eric. That was really, really great session. That was a really great presentation. It was quite technical, but it was also well detailed, and you broke it down as much as you could to help us understand it. And I'm sure a lot of people have questions. And I also understand that people are more interested on, okay, how does this affect my taxes? What will happen? How can I get involved? And I know you mentioned Rex is the tax, expert. He has experience with working in the IRS, and so I'm going to give him some time to also talk to us about the tax side of things, and he shares experience with us as far as what people should know information wise, and how they can get invested as well. Rex, over to you, please. Thank you.
Well, basically, what we have an opportunity to offer is for accredited investors. We offer them as close to an industry possibility because as partners in our sponsored fund, which is King Operating Partners 2 LP, you actually own all of the components of the oil fields that were being developed. So, as Eric pointed out, we have four primary oil fields. So, you receive significant diversification, and we have a balance of product mix of both oil and natural gas. So we believe that we're offering the best product available on a industry-like participation for accredited investors. From an income tax perspective, as was pointed out in the initial slides, the primary driver of the first year deduction is intangible drilling costs, and that is specially allocated on your K1. It'll show up on line 13J of the K1. And there's two particular treatments that you can elect for that. The primary is IDCs is deductible when either paid or incurred. Our components of our limited partnership agreement, and also we have a corresponding management and maintenance agreement that is all included in our private placement offering. We require prepayment. So because we require prepayment, the IDCs, when they're paid, because they're paid in advance, are currently deductible in the year that you subscribe. So again, that deduction represents normally about 70% of a subscription price. And then in addition to that, first year deductions are for tangible costs. And one component is bonus depreciation, which is Section 168K, that allows, at least in 2023, an 80% deduction. And then the balance of the 20% that is not deducted, as pointed out, you take maker's depreciation over a 7-year period. But the combined percentage of the IDC and the bonus depreciation, the maker's depreciation, and also a possible cost depletion allowance can achieve a 75 to 85% first year deduction expressed as a percentage of the amount that you elect to participate or the subscription that you complete. We do generate passive income, which are partnership distributions. Everyone is often confused about how partnerships are taxed. Partnerships are a pass-through entity, and the way that works is that as of December 31, because we're definitely using a calendar year partnership fiscal period, is all of the taxable income is tallied, all of the allowable deductions are tallied, and the two are combined, and the partnership either generates a net taxable loss for the period or a net taxable income. Obviously, as we're drilling and incurring all of these IDC and tangible deductions, the first year, specifically 2023, is going to generate somewhere between a 75 to an 85% first year deduction, which yields, in our simple example, the $60,000 projected tax savings based on a marginal bracket. As long as the partnership is generating net taxable losses, all of the partnership distributions really come back to you as a return of capital and are non-taxable. Once the partnership generates a net taxable income, then a portion of those distributions do represent a component of taxable income, which again, you can also utilize the percentage depletion depletion, you calculate either the greater of cost depletion or percentage depletion and deduct whichever is greater on an annual basis. But in a nutshell, we're projecting 75 to 85% first year deduction in 2023, and that is generated primarily by the IDC deduction, the tangible deduction for bonus depreciation, uh, standard depreciation, and possible cost depletion.
Okay. Thank you. Thank you, Rex. That's awesome. I have a couple of questions that have been some of those that signed up for the webinar had sent ahead before now. I'm going to go over some of them. And if you have any question on if you're online and you're watching us and you have any questions, please do feel free to put them in the comments and we're going to get to that very shortly. I'm trying to make sure that we don't take too much of your time. But let me go over some of the questions that I have. So one question I have is that what is the minimum capital requirement to invest in to get invested with you guys?
Yeah, so we have a $200,000 unit value, but we do accept half units, so $100,000.
Okay, thank you. The other question I have is so when you say $100,000, are you able to allow people? Pooled funds where individuals are unable to meet up with that $100,000. If two people can pull together maybe 50,000 dollars, can they jointly invest as just one unit?
Well, we are for accredited investors only. So if it depends on accreditation. So if you are accredited and just are having cash flow issues, there's definitely things that can be done. But if you're not accredited and don't have that type of capital, unfortunately, that's the law. We can't accept that capital.
Yeah. Okay.
Yeah.
So for accredited, it has to be only accredited investors, correct?
Correct.
Yeah.
Correct.
Okay. Perfect. Okay.
And
So that.
through our partnership, on a case by case basis, if you have 50,000, we can talk to them, and then we might be able to get them in, as long
Okay.
as they're accredited,
Yeah, we can
but
make
not
exceptions.
below that though,
Okay.
Yeah, we
because
can
then
make
the
exceptions.
tax benefit. Yeah, I
Well,
wanted to be saying.
let me cover this, Dr. Bio, just for legal
Yeah.
purposes here. Yeah, there are exceptions we can make for accredited investors, but you have to be accredited, and we have to speak with you in order to determine whether or not it's viable for us on a legal basis.
This. Okay.
Yeah.
Keep you out of trouble there, Dr. Bio.
Yes.
Yeah. And is this a working interest or a royalty interest? When I mean
The
working.
partnership is acquiring working interest in oil and gas mineral interests, correct, that are
Okay.
commonly called leasehold assets.
Okay, because the reason why I'm asking about that is really, when we talk about limited partnerships, we understand it's passive, and so when people are talking about using this strategy as tax savings, the key concern there is whether it is deductible as against whether the passive losses are deductible against active income, W-2 income from businesses and all that. And so what I wanted to get from you guys is that in this situation is this losses like are these passive losses deductible on non-passive sources of income?
So upon election to subscribe, you make the election of whether or not you want to be a general partner or a limited partner.
Okay.
Basically, the passive loss rules are all under Code Section 469 if you get technical. There is an exception, which is Code Section 469C3, that basically says if you subscribe to a limited partner as a general partner, then all of your losses can be used against any form of income. One thing that makes our program extremely unique is in our partnership agreement, we basically have a conversion factor where if you subscribe as a general partner, once all the subscribed funds are expended, which assuming that we have full funding of this program or the 200 million before December 31st, then all of the subscribed funds would have been expended at that point. As of January 1, 2024, all general partners will will automatically convert to a limited partner. Some individuals
Well,
say,
hold on, Rex. That's if we raise the full capital and deploy all of it into the field. So December 1st, 2025 is a more logical explanation. You want to set the right expectations for y'all.
Okay, thank you. I guess just one other question here. Okay, so in terms of the K1, I know they're gonna get the K1, and so how what's the timeline for getting the K1? I mean, a lot of tax payers pay. I mean, file their taxes before the April 15 deadline. Are there any specific information they will get after signing up contract and all of those stuff? What are the things they're going to get back in terms of documentation and tax document that will help them have these conversations with their tax preparer or CPA, as the case may be?
our goal is to have all of the K1s done by March 31st. I'm sorry, March 15th. Now, last year, program 4, we delivered the K1s on March 13th. Unfortunately, because of the complexities of our program 3, they were delivered on March 31st. But we will definitely target somewhere between March 1 and March 15th for 2024.
Okay. Um, so I have a couple of questions here. So how do EU residents participate, and what are the potential benefits for EU residents?
Well, again, they would participate as any other limited partner. However, there is a withholding requirement. On an annual basis, they would receive their K1, and then they would also receive an 805, which would show the amount of tax that was withheld, and the tax would be at the rate of their connected U.S. income rate, which probably would be at a 37%, or if they invested through a foreign corporation, that would be at a 21%. The main thing is for 2023, for instance, because the partnership was generating a net taxable loss, there would be no withholding on the basis of the MPI distributions that are being made. Assuming 2024, there's only a marginal net taxable income, the withholding rate would only be on the basis of their allocated share of net taxable income, which again would be at 37%. So, for instance, they may get, hypothetically, I'm just pulling numbers out of the air, they may get $30,000 worth of distributions in 2024, but yet their share of allocated taxable income would be half that. So the tax would be 37% of $15,000.
Okay, then I have another question here that says, when are we looking for the returns to start? I mean, when would they begin to get an ROI on their investments?
That begins 60 days after investment. So for the since November of last year, it has been waiting game until now, but production has begun. So 60 days after investment, the way it works is when we pull oil out of the ground and sell it to a broker, we get paid 60 days later. So after the month of your investment, basically you skip a month, and the following month after that, you start getting MPI.
Thank you. And then one other question again. Does the EU investors have to be accredited investors as well, just like the US investors?
Yes.
Yes.
Okay. I think I've okay answered. I think that's all the questions I have on the screen here, and all the questions I have written down. Thank you very much, guys. Thank you so much for this wonderful session. It's really been very informative and helpful. And I hope that I would continue to look out for questions from a lot of people that have, indicated interest in this investment, and I'll definitely be in touch with you guys, Eric and Rex, as well as Dr. Fasanya. And of course, if I have other questions, definitely I'll also be reaching out with you. And I want to thank you for spending this time with us, and I'll be wrapping it up here. And I hope you have a wonderful weekend. And for those of you that joined us today, thank you again for joining. I hope this has been very helpful for you. Whether you want to invest now or you plan to invest in the future, this will definitely come handy for you as well. Thank you, everyone, and have a wonderful rest of the weekend. Bye bye.
Thank you, everyone.
Yep.
Have a great
Thanks
weekend,
for
everyone.
having me.
Thank
You too.
you.
Yeah.
Take care.
Bye.
Yeah.